Hello, I'm Sambodhi Sarkar, currently a student of second year St. Stephen's College, Delhi.
In this video, I want to fundamentally analyze L'Oreal using the Holt technique and show you why we should currently sell its shares. Started in 1907 by Eugene Schuller, a young French chemist, the L'Oreal Group is the world's largest cosmetic and beauty company today. It is structured into three branches: cosmetics, the body shop, and dermatology, and has brands like Garnier, Maybelline, etc. under its umbrella. Riding on key growth drivers like ability to constantly innovate using optimal R&D, a well-segmented portfolio that enables it to drive growth even in economically challenging times, the relative wealth chart shows that the CFROI level has been constantly above the cost of capital, which means the company is creating economic wealth, which gets reflected in the share price of L'Oreal. Under such conditions, ideally the company should try to build up assets, but we see regular exceptions to this where the management has taken decisions which led to negative asset growth, harming the share prices in those years. Even though L'Oreal has been able to generate high CFROI levels, but no company is immune to fade, and thus the Holt model predicts that the future CFROI level of the company will come down over the next 10 years. Though it is predicted to remain above the cost of capital, it is below the market implied CFROI levels. Similar is the case for Holt growth rates, shown in the asset turns chart. L'Oreal's brand diversity drives sales from their low-priced brand products to their high-priced brand products, catering to diverse populations across the globe, which have kept their whole operation margins stable, while the EBITDA margins have increased over the past years and the asset turns have been relatively stable. But the sales growth has been volatile, even turning negative, impacting the return on gross investment negatively in those years. We see an interesting pattern when we look at the historical expectations chart, where we see that the market implied CFROI level has always been above the T+1 forecast, resulting in negative to very negative spreads over the years.
Though the risk analysis gives us a positive picture with an overall score of 4 and a low probability of default, the momentum analysis tells us that the share price, which is currently higher than its moving average, has been coming down sharply and is expected to fall further. A comparison with its peers across the personal product sector in Europe suggests that it lies at the high end of the spectrum for accounting quality, but almost at the median of the asset growth sector. The total economic value per share is around 98.1 and the warranted equity value is around 91.84, which is at a 25% downside from the current market price, and thus I strongly recommend a sell opinion for it. Thank you.